How many times have you watched a video where it made trading seem so simple? You're told all you have to do is develop a trading idea, backtest it to make sure it's profitable, and then forward test it in a live market with a small amount of money at risk. I just recently got my spark plugs changed. To a mechanic who's been doing it for years, it's probably the simplest thing in the world. You take out the old plugs, you put the new ones in. But to me, as an outsider, I wouldn't even know where to begin. That's how it is with trading. When you're losing or breaking even, everything seems unclear. This video is a continuation of the series where we're developing a profitable trading system. In part 1, we went over 2 questions you must answer. Number 1, based on your personality, do you want to be a trend follower or do you favor a trend reversal system? And then number 2, you can either use indicators or a blank chart. If you missed part 1, I'll have a link in the description below. Today we're going to develop 2 reversal strategies based around ICT's Judas swing. Once we have a foundation, we're going to use the loon indicator we saw in a previous video to try to get better entries and filter out some of the losing trades. In my first ICT video, I went over the concept of liquidity. The idea in a nutshell is right before the true move, smart money will manipulate price, hunt stop losses, and only then will they send the price where they want it. Price is clearly in an uptrend. Let's say we want to get long. We buy one lot at market price. No big deal. Price is here. We get filled right where the price is. Now let's say a bank wants to put an order in. They also think price is going to go higher, but instead of one, they want to buy 1,000 lots. What do you think would happen if they just hit the button and market buy 1,000 lots? It would chew up all the liquidity, create slippage and much worse prices for itself. So by the time the bank is buying, maybe it's paying 300 pips higher than we would. The bank's obviously not in the business of losing money. So put yourself in their shoes. What would you do? So picture yourself as a buyer. Where would your stop loss most likely be? We're always taught a safe place to put it is below a recent low. When you're long and your stop loss gets hit, it automatically becomes a market sell order. Well, somebody has to take that other side of the trade. So you're selling, and that's where the banks come in. They're buying your sell. So banks want to push the price up higher, but they don't want to pay high prices. The only thing they have to do is push the price lower. You're forced to sell, and they buy at a much better price. So no matter where your stop loss was, you got taken out, the banks got filled, now they're ready to send the price higher. So smart money's not going to buy all the way up here. They're just going to manipulate and engineer a price to where they want it. How often have you been in a trade? A price wicks down, barely hits your stop loss, it takes you out, and then it turns right around and continues on without you. Now you know what most likely happened. In this video, we're going to look at 2 reversal systems. One will be pure ICT, and the other will be with the loon indicator. One of ICT's core teachings is price is engineered, and not only that, but certain times of the day are more important than others. Step 1 is we want to look at the chart right before 7:30 a.m. New York time. I've got my chart set to UTC -4, which is New York, and if you go up to the indicator, search for sessions. First one is by AU Rocks. Go ahead and put that on your chart. I've got the New York session selected, and it's going from 7:30 in the morning till 4:45 p.m. So we're at 7:25 in the morning. Right before 7:30, you want to mark out the recent high and the recent low. You can either watch the chart or just set an alert. We're not going to do anything until either the high or the low is hit. Remember, we're looking for manipulation. So if the high is hit, we're only going to look for short signals. And if the low is hit, we're only going to look for long signals. We get a close above, so we're only going to look for short signals. To make sure you understand so far, I'm going to go through a few examples. Pause the video and decide if you want to be short or long. Here's the start of another session. We mark out our highs and lows, and then we just wait. This time, the low was taken out. So now we have a long bias. We're looking for price to maybe continue lower, but we're only gonna look to go long. So step 4 is we're gonna wait for an opposite and obvious fair value gap. This is yesterday on Euro USD. We're about to open at 7:30. Recent high, recent low, now we just wait. So we've closed above the line. That means we have a short bias, but we don't automatically go short. We need to look for a bullish fair value gap. So in case you don't know, a fair value gap is a 3-candle pattern. For a bullish fair value gap, essentially the high of candle 1, the wick is not overlapped by the low of candle 3. So this shaded area is the gap. And then the same for a bearish fair value gap. The low of candle 1 is not overlapped by the high of candle 3. So this shaded is the gap. So usually the good ones pop right out at the chart. They're not too hard to see. So we've got the high, we've got the low, and there's no overlap. So right above that candle, we have another little fair value gap. But down below this would not be a fair value gap. And before I mention obvious fair value gap, this one technically is a fair value gap. The wicks do not overlap, but I look for and use the more obvious ones. So step 3, we close above, so we have a bearish bias. Step 4, we're gonna wait for a bullish fair value gap, and it has to be above the line. So no fair value gap. These two wicks overlap. So what do you think now? Is this a bullish fair value gap? So we're ignoring candle 2. We're looking at the wick of candle 1, the wick of candle 3. The high of candle 1 does not overlap with the low of candle 3. So we see this gap here. There are a few people on YouTube teaching about the fair value and inverse fair value gaps. I'd say Dodgy is probably your best bet. I'll leave a link in the description for his channel. Go check him out. Step 5 is we're gonna wait for an inverse fair value gap, which is essentially a close below the fair value gap. If it's not too far, we'll market sell. If it's a large stop loss, you can wait for retracement. If it takes the recent low, we would just pass on the trade. We're inside the fair value gap. We haven't closed. Even if it wicked below, we need a close below. All right, now what do you notice? Well, we took out the recent high, we took out liquidity, and we made a new fair value gap. We're not going to do anything until we get a close below this fair value gap, which we do on this candle. Stop loss above the recent high, which is a little over 7 pips. Not too far, so we can market sell. We know the market likes to target liquidity, and that's usually in the form of highs, lows, and equal highs. So as soon as we hit this recent low, we're gonna move our stop to break even. You can take a partial or you can let it ride. Second and probably final take profit would be these equal lows. So move stop to break even and take a partial if that's your style. And we'd be fully out at this point. Another example, we got our highs and lows marked out. Before we were looking at the 5-minute. I would say that's the highest time frame, but you can do this on a 3-minute, a 2-minute, a 1-minute chart. So we already have a lot of fair value gaps in here, but it doesn't matter, we're still waiting. Nothing happens until we break the high or the low with a close. So we wick through, but now we finally get a close below. We close below, so now we have a bullish, a long bias. We have our level. Now we need to wait for a signal. The signal is a bearish fair value gap. We see there's no overlap between these two candles, so this is a fair value gap. We're no longer going to use this higher fair value gap. We just got a new lower one. So we not only wicked above, but we closed above. This would be our trigger. we can enter a market long. So when setting your take profit, you want to think, where is an obvious spot? If you were short, where would your stop loss be? I'd probably set it just below this wick. Second take profit would be just above these recent highs. But I wouldn't wait for this first take profit to get hit to move my stop to break even. You want to look where is an obvious high or equal highs. So I'd either set it at this high or this high. Somewhere, anywhere in this region would be fine. So by now, I would be break even. Hit our first take profit. And we're out of the trade. Hit both take profits. It may look like we left a lot of money on the table, but we're going for the low-hanging fruit, the 2-to-1s, the 3-to-1s. We're not trying to hit the 6 or 7-to-1 home runs. This is yesterday's session. Price dropped 100 pips. Let's go back and use fair value gaps and see where we would have gotten in. So as usual, we mark the high, we mark the low, and we get a close above, so we know our bias is short, which end up being correct. We can't do anything until we get a fair value gap. These overlap, so we have to keep waiting. High and low overlap, no fair value gap. Once again, the overlap, we only take this trade until about 11:30, so we have 45 more minutes. And it's 11:30. We didn't get a single fair value gap the whole 4 hours from 7:30 to 11:30. So there's no trade. Now I'm going to show you a way, instead of using fair value gaps, we can use indicators to catch reversals. I'll leave a link for Loon in the description below. Once you sign up, go to your indicators and then click on invite only. Now we're going to use the market analysis and the oscillator premium. For the Loon oscillator, I have it set to slow, velocity is fast, peak is 3, pulse is 5, pulse is 1, wave is 3. Market pressure is 2. I have it selected to the reversal and then regular divergence. Up top on market analysis, I have the signal mode set to contrarian, which is the reversal mode. Sensitivity is 25, signal velocity is auto. I have trade exits, clarity AI, and the advanced algorithm checked. Scrolling down, I also use the vision pulse and the reversal radar. So step 1 and 2 with the indicator are exactly the same thing. Before 7:30, we're gonna draw the high and the low. We're not gonna do anything until 1 is hit. If the high is hit, we have a short bias. If the low is hit, then we're only looking for long trades. We hit, but we actually want to close above. We closed above. Now is the only time that I would turn on the indicator. So I've tested a lot of different ways. This is my personal system. I need 3 points within 6 candles. And a point can be, for short, a red box, a red arc, or a red arrow. So this is outside of our time, but just for illustration, we've got a red arrow down here. The arc is 6 candles long, but I count all of this as 1 point. I lump all of the 6 candles together. But within that arc, we also have a box right here. So this would be 2 points. None of these would be trades though. So the full arc counts as 1 candle and 1 point. So the arc is 1 point, the box is 1 point. This is the second candle. 2, 3, 4, 5, 6. We don't have another point, so we only have 2 points and 6 candles. So this would not be a valid trade. Here we have 1 point, second, third, fourth, fifth, sixth candle. We only have 1 point. Here's the first point, second candle, third candle is 2 points, 4, 5, 6. We only have 2 points. So we just saw we got our close above. This is where we turn on the indicator. So we can see right off the bat, we have 2 points. There's the start of the arc, and then we also have a box here. All of this arc counts as 1 candle. So 1, 2, 3, 4, 5, 6. 6 candles make up 1 arc. So this is the second candle, and we have 1, 2 points. Third candle, 2 points. Fourth candle, 2 points. Fifth candle, and we get our 3rd point. We would take a short right away. As far as stop loss, normally we would look to the left, see if there's any kind of recent high, any kind of order block. any kind of market structure, any kind of clue. Here we don't really have any reference point to the left, so I would say about double the size of this box. In terms of take profit, I see equal lows right here. This would be my first take profit. And then I see relative equal lows here. So we got a 2.3 and then about a 3.5. If I were long here, I would assume most people would set their stop loss probably around here. So this would be a good break-even point. So here we hit our first take profit and second take profit. We're fully out of the trade. And as we saw before, price went a lot farther than our take profit. We actually took a lot of these lows out. We could have had about 11 to 1. If you want to hold longer, that's up to you. If you like the higher R to R trades, I tend to go for the low-hanging fruit. Really, no system is perfect. We're going to look at a few different examples. Sometimes Loon is better, sometimes ICT is better. We mark out the highs and the lows. Obviously, the high is broken. So now we are looking for a short. So since we're looking for a short, the first thing we need to see is a bullish fair value gap. We see our gap there, and then we get a close below. So this is where we market sell. Stop loss above, first take profit, second take profit. Price actually moves up. We take a loss on the trade. So now let's look at Loon. So we close above. This is the first point. Got a box. Second candle, third candle, fourth candle, fifth candle, sixth candle. So we're not going to use this one. First candle here. 1 point, 2 points. All of this counts as one candle under the arc. So 2 points, second candle, third, fourth, fifth, sixth. Only 2 points within 6 candles, and we reach lunchtime. So with ICT, we lost 1 R. With Loon, we were stopped from taking a trade. So we actually benefited using the indicator instead of ICT. Here on the 5-minute, we get a close below, so we're only looking for longs. Zooming into the 5-minute, this is where we close below, so we start looking here. We want to see a bearish fair value gap. We get one here, but we close above the line. So no trade for ICT. With Loon, we don't get any indicators either. So no trade on the 5-minute. Same story on the 3-minute. We do get a fair value gap. We inverse it, but it's above the line. So no trade. And then for Loon, no indicators. On the 2-minute, it's the same story. We get a bearish fair value gap. We inverse it, but it's above the line. So no trade for ICT. And then for the Loon indicator, we only get 1 point. So no trade. So now we're on the 1-minute of the same chart. Zooming in, we get an obvious fair value gap. We would enter here, stop loss below here. So right around 1045. So at 1045, about right here, stop loss here. Say probably first take profit here, and this looks like an obvious second take profit. Break even would be these equal highs. So this looks like about a 3 to 1, and the second take profit, about a 4 to 1 using ICT. So going back to the 1-minute, let's look at what Loon gave us. Here's the first point, second candle, third candle, fourth, fifth, sixth, no trade. Here's our next point. 1 candle, 2 candle, 3 candle, 4 candle, so no trade for Loon. Here's another chart. We set our levels, price closed above the high first. So we're looking for a short. Let's jump down to the 1-minute and see what ICT and Loon gave us. So first ICT. Here's our obvious fair value gap. We close below here. Stop loss, probably around here somewhere. And then we wouldn't go break even till about here. Here we're break even, first take profit, or second take profit down here. Price moves up. We're stopped out at break even. With Loon, so here is our first point, second point, third point, all within 1, 2 candles. Here's our entry, stop loss, take profit or break even, same place, and then final down here. So same situation, we stopped at a break even. So at this point, it's only about 9:30. We can look for another trade. So first, let's do ICT. We're looking for a bullish fair value gap. So here's the first bullish fair value gap, but we closed below the line. So we're not going to take that. And that was the last one, so no trade for ICT. So here's our first point. 1 candle, 2 candle, 3 candle, 4 candle, 5 candle. We get our second point. 6 candle, we get our third point. So this is a legitimate trade. Entry here, stop loss here. First take profit and break even, and then second take profit. Price comes down, we hit our first take profit, move stop loss to break even. And this is where we would have gotten stopped out for the other half of our position. So with ICT, we took one break even trade. With Loon, we took one break even trade. Second trade, we made it to our first take profit, and then we got stopped out on the second half of our trade for break even. Here on the 5-minute, we closed below our level, so we're only going to look for longs. Let's zoom in and see how ICT and Loon did. Here's our first fair value gap. We get a new one, so we would not use this higher one. Once again, we get a lower fair value gap. This is the one we want to fill in now. We stopped looking for entries around 11:30. This never got inversed, so no trade for ICT. Now let's look at Loon. So 1 point, 2 point, all this falls under the first arc. So here's our second candle, third candle, fourth candle, and we get our third point. So this is our entry. I'd set my stop loss under the low, and no matter where you set your take profit, stop loss would have been hit. So that would have been a loss for Loon. Same chart, but this is a 3-minute, and then we're going to stop looking for trades around 11:30. So ICT, here's a fair value gap, fair value gap, fair value gap, fair value gap here. So with ICT, entry here, stop loss here, take profit is somewhere up here, but it doesn't matter because we took a loss with ICT. If we want to look for another re-entry, here's a fair value gap, but we never inversed it. So we only took one trade with ICT. With Loon, here's our first point, second candle, third candle, fourth candle, fifth candle, it's 2 points, sixth candle, we only had 2 points, so there's no trade. Here's our next signal, 1 point, second candle, third, fourth, fifth, sixth. Here's our next signal, here's 1 candle, 1 point. Look down here, we get another point, so that's 2 points, 3, 4, 5, 6, no trade. So here on the 3-minute, ICT, we took one loss. Loon, there were no trades. So ICT, here's our fair value gap here. This would be our entry, stop loss here, take profit somewhere up here, but this is where we get stopped out. So we took one loss with ICT. With Loon, here's 1 point, second candle, 3, 4, 5, 6. First point, second, third, fourth, fifth, sixth, no trade. 1 point, second candle, third, fourth, fifth, sixth, no trade. 1 point, 2, 3, 4, 5, 6, no trade. 1 point, 2 points, 3, 4, 5, 6, no trade. ICT, we took one loss on the 2-minute. Loon, we took no trades. Here's where our lower line would be. We close above, so we're obviously looking for short. The rest of the day, price continues higher. So if we get any kind of signal, it's most likely going to be a loss. Here's the first fair value gap. Entry here. We do have equal lows, which it doesn't look like we got. So this would have been a loss. With Loon, this starts below the line, so it doesn't count. So this is 1 point, 2, 3, 4, 5. Second point at 6. So we restart the count. Here's 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. So none of these were trades. Get another signal here. 1, 2, 3, 4, 5, 6. 1, 2, 3, 4, 5, 6. And we run into 1130, so no trade. Here we took out the low first, so we're looking for long. Since we're bullish, we first want to see a bearish fair value gap, which is right here. Close above. Here's our entry, here's our stop. So we entered right around the 9 o'clock candle. So looking at Loon, this is our first point. Second candle, third, fourth, fifth, sixth candle, and then the box falls within the ribbon. So we have 1 point, 2 point, 3 points. This is where our entry would be. So between ICT and Loon, we'd enter between 8:45 and 9 o'clock. Going back up to the chart, we're entering somewhere around here. Stop loss would be below the lows. I'm probably getting out here. This is about a 3-to-1. You know, once again, there is a lot more to be had oftentimes if you want to go for those higher R to R trades. I've never been a fan of videos where they cherry pick the perfect scenarios and make you think the system is ideal. I've screenshotted hundreds of charts. Sometimes ICT is better than Loon. Sometimes Loon is better than ICT. Other times they win or lose about the same. The link for the Loon indicator is in the description below. Backtest both ways. If you have any questions, let me know in the comments below. Now we're gonna go over a few more things to consider. Most of the time we're gonna have a good idea about the daily bias, but sometimes we're gonna be completely wrong. Price closed below the line, so we're only looking for longs. When we get entry signals but price keeps going down, at some point we have to realize we're out of sync with the market and cut our losses. I wouldn't want to take more than 2 losses on a pair in a session. If you take the first loss and the second trade is break even, feel free to take the third as long as it's a valid setup before 11:30. Let's take a look at this chart. We got 1 point, 2 points, and 3 points. Here's our entry, stop loss around here somewhere, and that's our first loss. So arc is 1 point. We've got another point down here. Here's our third point. Entry, stop loss. Entry, stop loss down here somewhere. So we've already taken 3 losses. So here's our line. We get a close above. We'd be looking for short. It's a little after 9 o'clock. It goes without saying you have to be aware of when news is. Here it's obviously the 10 a.m. news candle. If you were looking for short, you would have got your face ripped off. If news is coming up, just stay out of it. So we close above the line. We've got 1 point, arc is 2. Here's our third. Typically this would be our entry. We're looking for a short, break even here, stop loss up here somewhere. Obviously the news just completely wrecks it, but we would have not taken the trade in the first place. Here's a trade that worked out, but I probably wouldn't have taken. We close above, so we're looking for short. So here's 1 point, 2 points, 3 points. We closed just barely below the line. So on that 3-minute chart, essentially we're closing right about here. Stop loss up here and can easily get probably a 4 or 5-to-1. The last trade we closed on the wrong side, but ended up making a profit. For every time it works, I can show you a handful of times you would have lost money. Here we closed above, so we're looking for shorts. So on the 5-minute, we get 1 point, 2, 3, 4, 5, 6, cancels out. 1 point, 2 point, 3 points. We're looking for short, but we're below the line. Here, stop loss would be up here somewhere. And of course, we end up taking the loss. Moving down to the 3-minute chart. So first point with the arrow, 2, 3, 4, 5, and 6. Here's our third point. We're going short, but it's below the line. So even on the 3-minute, we end up taking a loss. So if you're still watching, I've saved the best for last. Through my back testing, I've looked at hundreds and hundreds of charts. What I've noticed is it doesn't have to be either or. Sometimes Loon gives you a better entry, sometimes ICT gives you better entry, but the most profitable trades are when Loon and ICT agree. So with Loon, here's 1 point, 2, 3, 4, 5, 6, no trade. 1, 2, 3, 4, 5, 6. This would be our entry. With ICT, we're looking to go long, so we want to see a bearish fair value gap. First one we get is over here. And with ICT, this would be our entry. So Loon, we get a better entry with ICT, but the main point is we get an entry with both of them. So sometimes you can wait to get confirmation and then you can take the trade. First entry was around 10:15, second was around 11:15. So we're getting in somewhere kind of in this area, stop below here, and this could easily be a 4-to-1. You might find your winning strategy trading ICT, or maybe you see it's easier to follow the signals the Loon indicator gives you. I'd recommend giving both of them a shot. Backtest, and once you understand the rules, trade it with a small account. Loon is a premium indicator, but let's say I'm trading a 100K prop account. I risk 0.5%, take profit at 2-to-1 for $1,000 profit. You'd only have to win one trade and it'll pay for itself for years and years to come. The investment of the indicator is really a drop in the bucket compared to what you could be making. Let me know if you have any questions about the rules of the reversal systems. In the meantime, if you want to check out part 1 of the series where I go over reversal versus trend following and common indicator mistakes, click here. Or if you want to know more about what ICT teaches, click here. Thanks for watching. Talk to you soon.